Here are 4 huge tax mistakes that retirees make all the time. We're going to cover them in this video. We're going to cover the pros and cons of different benefits and different ways that you can strategize to save the most amount of money in taxes. We're going to talk about one tactic that very few people actually look at from a holistic perspective, the true and false perspectives of a Roth, because there are some benefits, but also some negatives, some tax hikes that might trigger some mistakes that you could make down the road, and the secret way to be Santa Claus that can save you an awful lot of money as well as reduce your amount of taxes in the future. So the first I'm going to cover is, did you know there's up to $89,000 if you're married tax-free? That's right, it's called the capital gains distributions. This is if you're married. You can see it right here between single and married couples. So if you're single, you have up to $44,625,000, married up to $89,250. This is what you can grab out of any kind of accounts that you have that are brokered accounts growing, and this allows you to take out a big chunk of money tax-free. Now, if you don't realize that you can do this, you can, because you have to bear in mind these are capital gains and not income. Because this way for you to take money out is one of the greatest ways you can do to take money out tax-free. Let's give an example of Frank and Susan. They have $30,000 that they draw from their IRA, $89,000 they can pull from capital gains from a brokered account. They have a $30,000 standard deduction. That means the $89,000 they took out is not taxable. That makes $119,000 up to $119,000 tax-free that they can take using the standard deduction, as well as maxing out their capital gains deductions. But one thing you have to be careful of is, even though that could be true, this could also escalate other taxes. And this is where the confusion of the tax code is. And I'm an enrolled agent by the IRS, by the way. If you're over 65 years old and you're taking Social Security, whatever age you start drawing from Social Security, when it comes to provisional incomes and IRMAA tax that can be triggered in Medicare, there's a lot of other things. And provisional taxes can be triggered using other techniques, because you can spike into what's called your IRMAA tax, which is a tax they put on people receiving Medicare, and it can increase your taxes. Now let's talk about the mistakes that people make when it comes to Roth conversions. And this is actually a huge problem, especially with all the marketing and all of the other professionals out there talking about the benefits of a Roth, talking about it very superficially and not holistically, because Roth is simply tax arbitrage. Simply means you're taking taxes at the bracket you're taking and hoping that's cheaper sometime in the future. That's all that really a Roth conversion is. But this can be a bad thing if you convert too much or you do it improperly. But too little could also be bad if you can have a way for you to do a Roth conversion, and it can save you money on taxes. And if you do too little, it can also be a disadvantage as well. So there's a little bit of the Goldilocks rule. Not too much, not too little. There's kind of a happy median on the Roth. So let me simplify the brackets when it comes to filers. Now, this is for single filers, and this is for married. Now, I'm not going to go through every single age, but I want you to focus here on the brackets, because these brackets I want you to think of as buckets. You can fill them up. So let's say, for example, you've reviewed your taxes with a tax professional, and they know that when you start triggering your RMDs and you are a high net worth individual, that you're going to be somewhere in the 22 or 24% bucket. Well, what you need to do is you need to see if you can fill up the 12% bucket to the max with your Roth conversions. So if you have some low income years where you're in the 12% bracket, you want to fill it up as a bucket. This way you're saving future taxes down the road. This is also true if you're going to be into the 32 or 35% to see if you can fill in those 22, 24% brackets. Okay, that's the benefit of the Roth, is looking at it as a form of arbitrage in low income years. But don't base it on the brackets alone. You have to look at it from the marginal conversion. So for example, one of the things that I've seen a lot of people do when they give these kind of Roth conversions is they simply just show them the marginal tax brackets, and they say, okay, we're going to fill up this bracket to the max, which could be true, but you have to look at it from how much money you're going to trigger the overall taxes, because this can increase your Social Security taxes, especially when it comes to provisional income. You look at the complete picture of how this is going to help you. So this is a case study I've used before, and I go through the Roth conversion line. I'm not saying Roth conversions are all lies. I'm just saying is that marketers oversell them as lies. This is an example of someone who was dead set on doing a Roth conversion. So I took out a tax return, I filled it for her. Her current income was $121,000. Her marginal rate was 16%. Looks good. She wanted to do a conversion of approximately $180,000, And if you see the difference between 16% and 24%, you're like, well, that's only an 8% difference in tax. It makes sense potentially to do this because she'll be tax-free in the future. One problem. That is, you have to look at how much money that she's using for the conversion, roughly $180,000, into the fact that her tax increase can be $51,000. So her real marginal tax rate on that is 28% taxes. 28%. It changes your perspective quite a bit. So be very careful when people use superficial numbers without looking at the full picture. The other way you can save money on taxes is by pulling in some of your losses on some investments that you don't like anymore. Some things you want to get out of. This is called tax loss harvesting. Now, this can be oversold as well and seen as some kind of panacea to fix all your tax problems. But the truth is that it can be effective because you can take some investments that you don't like anymore, sell them at a loss to offset some of your gains, but you have to bear in mind this only goes up to $3,000 a year in tax savings. So please, this only offsets $3,000, okay? But one thing you can do is that if you go past that, there's some investment you want to sell at a loss, you can actually roll forward that loss into future years, again, only up to $3,000. So really what this does is it's a way for you to offset capital gains by underperforming assets, reducing those taxes, right? So you're reducing other taxes that did very well on some losses up to $3,000 a year. So people don't utilize this, but they can. And then of course you can roll it into years. So let me explain this to you really fast. Let's say, for example, we want to carry forward that loss. So the limit's $3,000. That's the most you can carry forward, but you can use any of the unused portion into the next year. And what this does is allows you to rebalance your portfolio and take underperforming assets, get them out, utilize the tax breaks, and this allows you to take some of the things that you want to reinvest in. But there's one huge problem that you need to be careful of. Some people try doing this where they sell those underperforming assets, try to claim it as a loss, and buy back that same stock. There's what's called the wash rule. The IRS is very aware of this. There has to be a 30-day window between when you sell it and when you get it back. And if you buy it back, you cannot use that loss. And that applies to any identical to security that you want to create a loss on. So if you want to create a loss, be careful about getting it back within 30 days. Now, the next thing I mentioned before is one way that you can give your money to charity like Santa Claus and get tax breaks. One thing I'm very much against is for you to use your post-tax money and then give it to any charity. Don't do that. One of the best things to use is what's called a qualified charitable donation, which means that you're going to take money from your qualified funds and send it directly to the charity. And this way, there's no tax for you. You can give more money to the charity, and you get to lower your tax basis in the future because now your RMDs are now decreased. This creates a true win-win for you. So this is one of the best ways for you to go out there and donate, where you get a benefit up front. You get to lower your RMDs, and the charity gets to win because they get to receive more money. And if you think that's good, there's so many other great tax strategies that you can use. Click the link below and get our help with getting the best tax strategies for you in retirement. This way you can have the best retirement possible. And I'll see you on the next video.